Hi, welcome back to the channel. Today we're talking about mortgages and specifically your mortgage and what you can do to repay it early. Now there are two very simple things that everybody can do to reduce the amount of their mortgage and pay it off earlier. And we'll get onto that later in the video. Before we do, I've got a very quick question for you. What rate of interest are you paying on your mortgage? Now, you might be able to answer that off the top of your head, but I would bet the vast majority of people watching this right now can't tell me the rate of interest that they pay on their mortgage. Everybody is an expert when they're actually applying for mortgages. You shop around, you spend a lot of time looking at all the different options and find the best possible deal. But then once it's in place and you start making the regular payments, everyone seems to forget about it. And I would bet most of us can't remember the rate that they're paying or even when it's due to be repaid. These are details that are very easily forgotten, but actually are really, really important to you and your financial well-being. And if you're looking to achieve financial independence and pay your mortgage off, it's really important that you stay focused on the rate and the deal that you've got, because things change all the time. And I can tell you right now, rates have never been lower than this current period. So now is the perfect time to look at your rate, to look at your deal and have a think about whether or not you can do better, whether you can save some money. And we'll come on to that later in the video. But yeah, if you don't know what your rate is, go and find it, get a piece of paper, have a look, because it will be important to you to know exactly what you're paying and what deal you've got. And then that opens up all the opportunity for you to look into the options to do better than that rate today. So before we start, let's have a chat about how mortgages work, because it's important to understand the way that banks structure their mortgages and how much interest you pay versus your repayments. So let's look at an example of a 200,000 loan. And this doesn't matter whether we're talking pounds or dollars or any other currency. The principles are the same. It's all about how interest is calculated and how much you pay each month. And let's assume you're paying a rate of 5%. So we've got 5% interest, and we'll look at a mortgage calculator, and 200,000 at 5% interest gives us a monthly repayment of 1,074. So that number has been calculated based on a 30-year loan. So the way banks operate, when you take out a 30-year mortgage, they calculate how much you need to pay each month so that your balance comes down to zero after 30 years. So the way that it's structured is that in the early period of your mortgage, so that's the first 10 years or so, you'll be paying mostly interest. And then as the interest comes down, towards the end of your loan, you'll pay more in repayments. So if we've got a 200,000 loan at 5%, the annual interest on that will be 10,000. The monthly repayment is 1,074. That's what's been calculated by the bank. 1,074 times 12 is 12,888. So you will give to the bank 12,888. They will take 10,000 of that in interest, and 2,888 will be repaid from the balance. So at the end of year one, of the 12,888 you paid, 78% of that was taken in interest by the bank, and 22% of it was used to repay the loan. At the end of that 12-month period, your loan reduced from 200,000 to 197,112. And that's basically how mortgages work. Each year, the vast majority of the money that you hand over to the bank is taken by them for interest. They keep most of your money for themselves, for their profit, for their interest, and a small amount of it, so 22% in the first year in this example, is used as a repayment against the loan. So your loan stays very high in the early days, and most of the money that is paid by you is used to pay interest to the bank. So if you stick with the monthly repayments that the bank has proposed to you, that you've put in the agreement, it will take you 30 years to pay off that debt. And over that 30-year period, you will pay $186,512 in interest. So you borrowed $200,000 and you're paying back an additional $186,512 in interest. So actually, in total, you're giving the bank $386,512 for a $200,000 loan. You're almost paying double the amount back to the bank, which is incredibly expensive. And people don't seem to understand that. Everybody thinks that a mortgage is a good deal. In this example, a 5% interest rate doesn't sound very high. Actually sounds quite attractive. I'm only paying 5%. It seems like a small amount, but actually, when it's over 30 years, it becomes a huge amount of cash. So 5% every year for 30 years is going to hit you in the pocket. So you need to start thinking about how you can start to repay that mortgage quicker. And I'm going to give you 2 great things that you can do right now, even if you don't have any spare cash. So even if you're thinking, look, I don't have any way of increasing any payments, I don't have any spare money, I can't afford to do anything because these mortgage payments are crippling me, what can I do? So I'm going to give you 2 great ideas now that will work, that will reduce your mortgage quicker and will speed up the repayments and give you more flexibility and more financial freedom in your life. So the first thing that everybody should do is to start looking around for a better interest rate. So I said at the beginning of this video, I asked you what your current rate of interest is on your mortgage. Hopefully you know what that is now, but even if you don't, go and look at it after you've seen this video and find out. Unless you entered into a deal recently, it's very likely that there are better deals in the market right now than you agreed sometime in the past. The longer ago you agreed it, the worst rate you would have struck. So let's take an example, what we've just discussed, of 5%. Now 5% is not a bad rate. If you look over the last 20 or 30 years, 5% is quite attractive. It's lower than it would have been in many years in the past. But we're not living in the past, we're living in the current environment where interest rates are incredibly low, and they are forecast to stay incredibly low for at least the next 18 months. So you don't have to do this today, but the quicker you do it, the better from your point of view. So have a look at your rate, go on the internet right now, type in your details, how much your mortgage is and what you want to do, and you'll find a ton of different websites that will give you the best mortgage deals. There's loads of different comparison websites out there which will give you indications of rates right now. So go on, put the same details you've got in now. So the same amount for your loan. So you're literally just refinancing the exact same deal, but you're looking for a better rate. So you can have the same term that you've got now if you like, and go out and find a better rate. Now, in the market right now, you will find rates that are significantly lower than 5%. Depending on what you want to do. So you can take a fixed rate or you can have a floating variable rate. As I mentioned a couple of minutes ago, rates are forecast to stay low for quite a long time. So you could take a variable rate if you wish, but if you want certainty, go for the fixed rate. So let's look at an example where you can find a rate that's 2.5%. So 2.5%, significantly lower than 5%. So if you manage to get a deal where you switch your current mortgage from 5% to 2.5%, let's have a look at those same numbers that we just discussed. So on a 200,000 loan, 2.5% interest each year is going to cost you 5,000. That compares to 10,000 that we were looking at a 5% rate. So it's 5,000 cheaper every single year. So you've got 2 options. You can strike that deal, change your mortgage and reduce the amount of your repayments. But here's the clever part, and this is what you should all do. Rather than accepting the new lower repayment, which is likely to be something like $790 per month versus the amount we were paying before, which was $1,074, rather than paying the lower amount, refinance the deal. So move your mortgage onto a 2.5% rate so that the interest is reduced from $10,000 to $5,000. But rather than agreeing the $790 and paying that each month, actually stick with the original payment of $1,074. So effectively, you're paying an additional $284 off the balance every single month. So in the first year, if you do that, you will pay your balance down by an additional $3,408. So whereas previously you were only paying $2,888 down off your loan each year, now you'll be paying $6,296 off that loan in the first year. So you can see the difference that it would make. The lower amount of interest means that you're now paying down that loan faster than the bank originally wanted you to. It's not costing you a penny more. So if your rate was originally 5%, as we said, the payments were $1,074 per month. If you reduce your rate to 2.5% or whatever it is, then and stick with the original amount you were repaying, then you will be paying an additional amount each month off your loan. And what that means is the loan's going to go down faster, and then in year 2, the interest will be lower because you've got a lower balance. So the amount you owe the bank is less. Therefore, they calculate the interest based on the lower amount. And so the interest will go down further. And if you carry on paying the 1,074, you'll pay down even more in year 2 and year 3 and year 4 and so on. So that is the principle of how to pay down that loan quicker without actually having to spend a penny more than you're spending right now. You stick with the amount that your mortgage is costing you today, but if you refinance onto a lower rate, you'll be paying less interest and paying more of the balance, more of the principal will be paid down each month. So therefore, less interest will be charged, and then you'll pay down even more principal, and it becomes a self-fulfilling circle that you will pay down that mortgage much quicker than the 30 years that the bank wants you to. And in this example, if you followed those rules and stuck with the original payment of 1,074, it would take 10 years off the length of that mortgage. So you would reduce your balance to zero after 20 years rather than 30 years. And that, as we discussed, is without you spending 1 cent or 1 penny more on your mortgage than you're currently paying right now. So the key to it is find a better deal, remortgage, but keep paying the amount you are comfortable paying. So if you're happy with your mortgage payment today, keep paying that amount on a lower interest rate, and it will reduce the balance much quicker, and you'll hit financial freedom far earlier. The next level for this argument is actually if you can afford to pay more than you're currently paying. So in our example, if it's 1,074, but you could afford to pay 1,200 each month, then you could actually pay even more off the mortgage each month, and that's going to accelerate that repayment and the reduction of the loan. It's going to reduce your interest quicker, and you're going to hit that financial freedom that everybody's looking for far earlier. So if you can afford it, put as much as you can into your monthly repayments, pay down that amount, kill off the killer interest. Nobody wants to pay interest and profit to banks. It's not in our interest to do that. So pay it down as quickly as you can, and you'll hit that point where you've got no mortgage and you'll have financial freedom and the ability to do what you like. So let's just talk quickly about costs, because there is a cost involved in remortgaging your property, and that needs to be taken into account. So the starting point, have a look around on the internet for the best rate, but the starting point for you should be to talk to your existing lender. So whoever provides your mortgage right now, if you can find a better rate with them, and most mortgage lenders have better rates constantly. So speak to your existing lender, because if you can strike a deal with your existing mortgage provider, then you won't have to incur all of the legal costs of switching your mortgage to somebody else and all of the security and everything else around that. So that's the cheapest, quickest, and easiest way to do it. But it might be that you find such a good deal with another lender that you're able to take into account the extra cost involved in switching, and it will still save you money. And some lenders will cover some of those costs, so they might provide some free legal payments. They might give you some incentives, some cash back. Have a look around. There's lots of great deals. Mortgage providers know that when you switch, you're probably not going to switch every few months. It's not like a mobile phone contract or electricity and gas. It's not something that people are doing all the time. So they're happy to give you an incentive to move because they know that you're probably going to stick with them for quite a long time. So have a look around. Don't be afraid to look into it and talk to people, because at the end of the day, it's going to save you a significant amount of cash. So do that, and you'll be able to minimize your legal costs. But don't be afraid to switch mortgage providers if you have to, if it's the better deal. So every year you have to renew your car insurance, your home insurance. You look at the mobile phone deals, you look at your utility bills, and you think, well, I might move. I could save, $10, $20, $30 or pounds a month. But the saving you can make by moving your mortgage is huge. So people should be doing it more often. And that's the lasting message that I want to give you for this video, is that you must go and find your rate, find out what deal you're on, and get a better rate. Go onto the internet, find a better deal, and do it. Just move that mortgage. Save yourself some money. It's a bit of hassle. I know it's a pain. People don't really want all the grief of moving their mortgage once they've got it. But look at the numbers. Look how much money you could save. This is your path to financial freedom. If you do this, you'll be happier in the long term. You'll have more money. You'll have no debt. And it is definitely the way forward for everybody. And you've got to get into that mindset and start thinking about how to get rid of that mortgage quicker. Hopefully that's been useful. If you've liked what you've heard, please give me a thumbs up and subscribe, and I will see you again soon. Thank you.